Welcome to the Strategic Treasurer Podcast, your source for interesting Treasury news in your car, at the gym, or wherever you decide to tune in.
Since the financial crisis was well underway, the volume of regulations impacting Treasury has been unprecedented. Are Treasury groups current? Are they prepared to monitor impending regulations and emerging compliance requirements? In this episode of the podcast, Strategic Treasurers Craig Jeffery and Melody Hart explore some of the newer regulations and their impact, from KYC, Sanction Management, GDPR, Dodd-Frank, and FBAR.
Hello, I am Craig Jeffery, and I'm here with Melody Hart on the Treasury Update podcast. Welcome to the podcast, Melody.
Thank you.
Melody is one of Strategic Treasurer's experienced senior consultants who holds a leadership role for our compliance services. A former treasurer, her career was focused on corporate treasury until she joined the advisory side of the industry. Melody, with this concept of compliance and playing catch-up, why don't you start off by just describing the regulation background? We said in the beginning that the growth of regulations, the volume of regulations in Treasury in particular, has been unprecedented. Maybe you could just describe what that looks like.
Regulations have over a number of years been increasing, particularly since the financial crisis. And there are more and more increasing risk, which means that I would expect that more regulation will occur as the risks increase, because those are meant to control the risks.
So, Melody, as we look at this concept about compliance and playing catch-up, maybe you could start by explaining the regulatory background. What's changed, what brought about that change, and how does this have an impact on corporate treasuries in particular?
Yeah, what has happened over the period of years, particularly the onset of most of it was the financial crisis. Governments have been cracking down, putting in more regulations in order to avoid the kind of crisis that we went through back then. So they've been increasing. We've got FBAR, which is foreign bank account reporting, and we have KYC, know your customer. There's Dodd-Frank. Any number of things have come into being over the period of years. And as risks increase, I would expect more regulations to be added in the future or additional requirements to existing regulations.
From this, what new regulations have come into play in 2018 or got adjusted? I know you mentioned from the start of the financial crisis, 2002, 2008, there were a number of items proposed, and it's taken a while for them to work through the regulatory grid to become rules that need to be followed. So what's new in the last year, for example?
Well, GDPR was the biggest one for 2018. It's a global data protection regulation, and it was an EU regulation. It sets out principles for data management and for the rights of the individual. It imposes fines that can be revenue-based. So this regulation covers all companies that deal with the data of European Union citizens. So it's a critical regulation for corporate compliance officers. If you look at it, it's not just for companies headquartered in the EU. It is for anyone who has data on any EU citizen.
So this could include data and information that's kept in payment systems from Treasury perspective, even if they're not located in France or Germany, for example?
Yes, it covers any data that's personal data. It can mean their name, their address, their identification number, email address, any type of personal data.
Right. So it's not just the marketing element, which every country or region has some data protection requirements or some regime. This is perhaps the most intrusive or the most restrictive data protection that exists.
I would say so, yeah. It's very restrictive, and it requires a lot of different things, including encrypting data and keeping it secure both at rest and in transit, having a data protection officer. There's a lot of aspects of it that are very stringent.
Yeah, it's very interesting. We don't normally think of GDPR. We think of it from a marketing perspective mainly, but it certainly has an impact to Treasury groups that have customers, clients, or anyone who sits in an EU country. Obviously, EU doesn't cover Switzerland or Great Britain, but it does cover many countries that most of our audience deals in. Those are some of the ramifications of GDPR. then that's fairly new. Are there other new regulations or changes in existing ones that are worth noting that impact the Treasury profession?
Well, FBAR, they had delayed over and over and over again, requiring you still had to file, but they were delaying the date that you had to file, except that you had to file for all the past years. Now we don't have that. Now you do have to file, and it's due at the time in April that you would have to file. That's a new part, which means that people who are doing FBAR, and it's very administratively cumbersome, so often it was delayed. Now they have to up their game and get that data that much sooner so that they can file timely. It does allow you an extension, but still you need to file timely and it can't be waiting for years.
Yeah, now you and I have had a number of conversations on foreign bank account reporting, or FBAR. There's several different groups that are subject to the individual filing requirement. This is not talking about the corporate side. So what's the difference between the two types of individuals that are required to file?
Okay, so individuals who have their own bank account that's foreign would be required to file an FBAR. However, there's also individuals who have no financial interest in that particular bank account, but they're a signer on it. So that would be people who are in a corporation. Those people are required to file, and it incorporates two segments there, because a signer is defined as anyone who, alone or in conjunction with someone else, has the ability to disperse funds. So if you think of it, if I'm a wire initiator and you're a wire approver, we together have the authority to disperse those funds, and so therefore it encompasses not just people who are actual signers, it also includes people who are wire initiators and approvers.
So if I'm not an official signer, but I have access to an online system and me by myself or with someone else can move funds, I'm a signer under the FinCEN or FBAR rules, is what you're saying.
That's correct. That's correct.
But if, let's say I'm someone in AP and I'm entering information, and then eventually that results in a payment via check or via some other method, are those people included?
No, because they're not actually dispersing the funds. They're inputting data for a payment, but they aren't doing the next step of being the person to advise the bank to go ahead and send it.
Okay. There's other regulations that we talked about or that you mentioned besides FBAR and GDPR, and maybe some of these impacts have been felt in prior years or in the last couple of years. What are some other of these regulations? What are some of the impacts of these other regulations?
Well, one of the big ones, and it's really high on people in the corporation's list, it's the highest, in fact, on their list of concerns. It's KYC. And this is because of a couple reasons. One, it's very difficult. It's actually interesting because FBAR and KYC are both kind of tied to bank administration management. So KYC, you're trying to open accounts or trying to get payments done, and you have to go through a lot of detail and getting information for the bank, and it ends up lengthening the time to open an account. It can delay payments. It can reject a vendor. So there's any number of things that can cause problems. It can cause a problem of disruption, first of all, for the company if their payments are late or if someone's rejected or if they can't get an account open. And that's very disruptive to the business operations and the relationship management. But also, it is so cumbersome now to get all this information in order to open an account or to do all these transactions that you have a high administrative component happening within Treasury that ends up more workload for people. With Treasury departments shrinking in size, makes it more difficult to get everything done.
That's interesting. So the driver for KYC, FBAR, and some of the requirements around compliance for sanctioned parties, those are all pretty big issues. That seems to me to stem from the concern about paying for terrorism. Some of those started off more from money laundering, But it seems like a huge driver for that has been terrorism. Maybe see if I'm summarizing it correctly, and you can make comments on that. One is KYC is making sure that the banks know their customers, that accounts are set up with trusted entities. They're not fictitious or used for money laundering sources. FBAR is tracking both what the companies pay through maybe banking platforms that are not subject to U.S. regulations or governance because they're paid to a foreign entity through a foreign banking system where there's no direct teeth on the company. The point of nexus is a U.S. signer, someone who pays taxes in the U.S. And the other one is OFAC, the requirements to check payments before they're sent. So this idea of before you make a payment, you're reviewing it against a list of sanctioned people and entities, and then blocking it before a payment goes out to them. So you're checking to make sure accounts are controlled with KYC, OFAC before payments are made, and then control over accounts is more far-reaching with FBAR. Is that it, or is there more to that as well?
That is pretty much it. I mean, it is. They are trying to avoid terrorism payments, and they also are trying to capture any money laundering and people not paying their taxes in the U.S. So those regulations are structured that way. And I mean, we haven't seen much in terms of like FBAR of people being prosecuted, except for the most recent one with Manafort, where they used FBAR as part of their investigation. Interesting.
And that was that related to the individual's use of FBAR, or was that corporate?
No. Well, he had shell companies, so it was his use, but there were shell companies.
So KYC is a big issue. You said that was the number one issue. What's number two, and why are these of top concern?
Yeah, number two is actually FBAR, and you wouldn't think so because it's been around a long time. So you'd think that it would have died down a bit, in terms of that. People have their processes in place. But the reason it is still a concern is because it's again, another administratively heavy thing. There's a high percentage of companies that are doing this manually. So I think it's about 67% use spreadsheets, and 88% on FBAR specifically are either manual or partially manual in what they're doing. So there's more risks of getting the information correct. If it's international, sometimes it's hard to get the information from overseas, from various subsidiaries. So there's those risks. People aren't necessarily sure. Some companies are not sure whether they need to file. So they haven't addressed that part of it yet. So you have the combination of those. Having it be filing for individuals is the problem. Companies are filing, but the filing for individuals is where the concern comes in, because sometimes they can't find the employee. It's a former employee. So how are they going to file for them or give them their information? There's any number of things that create a risk there on filing for these individuals.
Sure. The employee is no longer an employee. They've moved 4 times. Do you really want to send banking information, account numbers to a former employee? That may not be required on the FinCEN side, but it is definitely a potential challenge. Let me ask the question about going back to KYC. Other than the extra work required to sign up for bank accounts, the extra hoops that you have to jump through for know your customer requirements that the different banks will put in place, are there other impacts for companies regarding KYC, or is that really the bulk of it?
Well, the other impacts have to do with the results of it. If you're delayed in opening an account, you're not able to, let's say it's a new entity even, you're trying to open an account, you're not able to do business until you have an account to place money in. So delays of account openings are difficult. Then if you're delayed on payments, that can be a problem for your vendors. They're not going to be too happy about not getting their payment on a timely basis. Or if the bank rejects them, then that creates a whole problem for the vendor and the company. It's very disruptive for business when that type of things happens. and it's not good for the relationship between the company and the vendor.
Yeah, having bank accounts opened is a foundational activity for doing business. Delays and hurdles delay that, make it more of a challenge. I think that certainly speaks to Treasury being current, figuring out what's going on, and connecting quickly with those banks. Jumping over to GDPR for a minute again, this is probably the newest, biggest regulation that Treasury people are talking about if they're not ignoring it. And it has some, I would say, challenging implications, particularly if you're marketing, but the fact that you can be storing individual information, or PII, personally identifiable information, within different payment systems and platforms. Maybe you can talk about why that's a challenge and what can be done about it, or just explain that in some more depth.
If you think about the GDPR, and yes, it certainly applies to markets. So think about Amazon. That must be very difficult for them, because I'm sure they have clients in the EU. That's one aspect, but you're right, the aspect of payments themselves. So if we have to make a payment to an individual, like an employee payment, which could be payroll or it could be some benefits payment or whatever, and you hold information of an EU citizen, you have to protect that data, which means that you're going to have to work with your IT department to make sure that they comply with the requirements of the data at rest and the data in transit. And you have to have gone out to these people. For each purpose, you have to have an explicit consent. So if I have a purpose that I'm going to be doing this for payroll, I need an explicit consent. If I'm doing it for another purpose, sending this person money, I need a different consent because it's a different purpose. And these people also have the ability to say they want to be forgotten. So at some point they say, I want you to forget me. Like maybe they're no longer an employee. And they say, I want you to forget me. Then they have to purge those records.
Now that's that certainly seems to make sense. Just like you want to opt out of getting email, you're like, I don't want that. They're sending me 5 a week. It's useless. I want to click and get off of it. But how is that different if it's in a payment system, right? There's banking requirements that surely overrule the desire to be forgotten, and having it purged out of an AP system or a banking system. The banking system won't delete it. What are some of the implications there?
Yeah, so the banking has a little bit different requirements, but it's the company that would be required to not maintain records of their personal data.
If I am an EU citizen and I leave a company, I could say after a time, remove me from your records. What if I have some sort of pension there that they have to keep track of to share information? Can you force them to delete you off of that?
Well, Craig, you're asking me a question I don't know.
Sorry. I'm just like there's some crazy things like the right to be forgotten. Yeah. There's some things you can't forget, and some things you're required. Like both the banks and the companies have to keep some of these payments there, and it's certainly for marketing stuff. I know it's like you got to delete them. You got to delete them, but it hard.
But who's going to want you to delete their information if they've got a pension coming?
I don't know, right? If someone says, well, maybe someone doesn't think about it, says remove me from all the records. I guess it would be there would be an obligation for whatever the governing pension requirement or 401k or whatever the particular regime is, that would supersede the request. They would have to keep enough information to comply with the rules and to provide
with their
funding.
Rules, yeah.
Yeah. Okay. That's a fun discussion. And so Treasury still has to think about those things, even though they don't have to care about it like a marketer would, who's running email lists or trying to capture names in different manners. But let's circle back to the practical side of things. So we talked about KYC, GDPR, different sanctioning bodies and sanction lists, FBAR. What should our listeners take away from this, particularly Treasury? What do they need to think about? What do they need to understand? And are there any actions that they need to take? Do you have any assignments for us, Melody?
Yeah, I guess the thing is, one, they need to understand the regulations. they need to keep up with them, and they need to communicate with others within the company about them. So the expectations surrounding Treasury and the compliance arena have escalated. So with all these dozens of compliance requirements that the companies have to adhere to, keeping track of all the additions and revisions proves complicated. So it's important that practitioners keep up on regulatory issues, and keep in mind that some regulatory issues like Dodd-Frank and KYC had implications for bank. They didn't specifically regulate the company, but it created the bank requiring things of the company. So sometimes even the bank regulations can have an effect. So it's always good to keep in communication with your banks and, of course, others in the Treasury field. In terms of actions, I would say the most important thing is to put in place a formalized process. Don't leave it to chance. You don't want to be the person who gets surprised by a regulation that you're not complying with. So as Treasury is forced to play a more active role in compliance, and as the overall compliance environment grows, you have to have a formal plan in place to manage the regulation on an ongoing basis. And that includes clear and efficient workflows for handling information and data gathering, as well as keeping track of new regulations and shifting requirements.
I think that's an interesting point you're making about keeping track of new regulations. I know you and I have done a number of webinars on that topic. That concept of staying current is vital. And you mentioned the example of many people aren't sure if a regulation applies to them. If you're not sure if a regulation applies to your company, to me, that seems like that's a huge red flag, because you should know this applies or it doesn't apply, or it applies in these areas for these reasons. That seems to be foundational, that initial filter, right, that you're looking for.
Oh, absolutely. It's incumbent on you to find out. If you don't know, you need to do the investigation to find out how it impacts the company. Because you don't want to be the person where your company's on the front page of the Wall Street Journal for not complying, and you use as your excuse you didn't know. That wouldn't fly very well. So it's really important that people do understand regulations and find out how it applies.
Yeah, avoiding the front page of the Financial Times or the Wall Street Journal is usually a low hurdle to succeed in your career. But you said something else that was interesting on compliance there at the end. You mentioned staying on top of things, communicating, figuring out what's going on. How should someone formally assign the process of monitoring for compliance issues, tracking them, gathering information? What's a person to do besides listen to your podcast, Melody?
Yeah, it's good to assign a specific person to monitor regulation. You know, if you just leave it out there that, let's have everybody got to monitor, it's probably not going to get done. It's better if you assign tasks. So assigning regulatory tasks, and that could be to one person, or you could split it. You know, say this person is going to follow this type of regulation, this one this type. You know, you can always split it up, but it's important to actually make sure that they do monitor it and report on it.
So someone might be responsible on the counterparty side or the debt or hedging side to someone tracks EMIR and Dodd-Frank activities related to that. Someone else tracks KYC and sanction filtering. Someone else who manages bank accounts monitors everything that touches that domain.
Right. And it would be a matter of, you have to just do investigation. You can access, websites to investigate it. You can talk to your bankers. You can talk to others within the Treasury field and get their take on it. And with all that information, then you can start pulling together what you feel your company is required to do.
Yeah, you also mentioned something on the indirect impact. There's regulations that may impact a bank that don't govern you as a corporate treasurer, but there's a secondary impact to that. Maybe you could just explain.
Yeah, I guess one of the examples I can really think about is Dodd-Frank, because there was that whole trading issue where you had to register. That was a requirement the bank was placing on companies, not that was the government placing on companies, but because the bank was required to know certain things, they had to come to the corporation to get that.
The next level down, right? Yeah, and I think some of the other banking regulations about the value of assets and hot money changed the value of certain deposits that were left on hand, meaning some assets were no longer desirable to be held by the bank, requiring you to perhaps find a home for it, or in some cases even pay interest to have your money held there, which does not tend to sit well with treasury people.
That's
so there's
true.
a lot of great there's a lot of great implications there, and we could jump into any of those. But Melody, you mentioned statistics on how many people are doing this or that or not doing something with regard to different compliance issues or regulation issues. Where can they get more information? I know you're referencing one of our surveys in particular.
They can go to strategictreasurer.com and register and get the information and download it if they like. Other sources, which won't be as detailed, having percentages or anything as our survey, but if they just want to talk to other Treasury people.
And it's interesting to see how that's changing over time as Treasury becomes much more compliance-oriented. Melody, I want to thank you for sharing your thoughts on the Treasury Update podcast on compliance, playing catch-up. Thank you.
Thank you, Greg.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.